they might bring a bit of that home. So I think that's where you get a bit of a cushion if there was to be something disorderly in the JGB market. Those guys bring it home and kind of team Japan in a way too, if the pension funds are state-owned banks with their government links. So I think that kind of caps where it can get to. But I think yen is diverging quite a bit lately from relative rates. It's been in lockstep. Relative rates, given US rates have dropped lately, more so than Japanese rates, would say 147, 146 on dollar yen, and here we are close to the 150 mark. It seems like the market is less worried that intervention comes in now, and they're more worried that maybe this thing can kind of break to the upside, because as much as the Bank of Japan has moved and effectively got rid of YCC, it's still nothing near where every other central bank is. So, for yen to do something meaningfully better, you really need more of a dovish pivot in every other central bank. Or I think you need the Bank of Japan to really start walking away from QE and negative rates. QE, it's kind of quietly forgotten, but their monthly run rate is 1% of GDP. That's how much QE they're doing now. I mean, the Fed and ECB barely ever did that pace. So, it's a non-trivial amount of yen being offered, if you like, every month. So is that on the cards for next year? Look, we tend to think so. But the BOJ have been, I think, behind the curve on inflation. They keep having to upgrade their numbers. They keep getting surprised. They just seem to be going a bit too slow. So yen strength next year, we think is going to be the case, but it's a bit harder, at least into year end.